China's performance in 2020 can only be characterised as spectacular. Not only did the authorities' swift and determined action against COVID-19 minimise the health and social costs of the pandemic, but virus suppression and subsequent stimulus saw a 10% contraction of the March quarter recouped within 3 months, and a further 6.5% gain achieved in the second half of 2020. Now, in 2021, as the rest of the world focuses on recovery, Chinese authorities will instead be implementing plans to maximise the return from and the duration of this new growth cycle. A quarterly annualised growth pulse of 5.5% to 6% through 2021 and 2022 is easily achievable, underpinned by a continued focus on quality investment and structural growth in consumer demand. In the June quarter of 2020, investment by government-related entities drove aggregate gains. However, through the second half of 2020, growth in private fixed asset investment accelerated. Importantly for the productivity of China's economy, this recovery in private investment has not only been seen in real estate, but broadly across the economy. Highlighting this, the manufacturing and service sectors wiped out respective losses of 32% and 23% between February and December 2020. Indeed, by December, services investment was actually 4% higher than in 2019. The recently announced PBOC requirement for China's banks to cap property-related lending as a share of total loans aims to make broad-based gains in investment permanent. By limiting growth in real estate, they are preserving bank capital for loans to up-and-coming industries. The consequence should be strong gains in national income and a more equitable distribution of returns over the long run. Sustained, robust growth in household consumption requires these goals be achieved. Without a steady uptrend in household income and wealth across the nation, gains in consumption, and indeed residential investment, could prove fleeting. This is particularly the case in a nation like China, where households have a high deposit hurdle to enter the housing market, as well as a need to save aggressively for their family's health needs and retirement. It also bears remembering that closed borders have provided domestic service producers with considerable support through 2020. As travel routes reopen and global risks related to COVID-19 dissipate, some Chinese households will look offshore again. To counteract this loss of domestic demand, other Chinese households need to be able and willing to increase their spending. Income gains will help this transition. Outside of tourism and education flows, reduced trade tensions and global recovery should support China's trade position over the forecast period. Indeed, Asia's strong economic prospects argue for upside risk for Chinese exports and industrial production as far as the eye can see. Some may look at the near 10% appreciation in China's currency against the US dollar since mid-2020 and posit that China faces competitiveness pressures. However, the renminbi is unlikely to prove a headwind. This is principally because the broad-based investment being undertaken in China is targeted at improving productivity and profitability. It must also be remembered that it is not only China's currency that is appreciating against the US dollar. On a trade-weighted basis, the renminbi's rise has only been about half that seen against the US dollar. We expect this will remain the case over the forecast period. As a result, gains for China from expanding its production base and reach into global markets will well and truly offset the renminbi's continued rise. We'll see you next time.